Over the next 20 years, we'll see the baby boomer generation born between 1946 and 1964 transfer most of their wealth to their kids and grandkids. And that equivalent is to over half America's invested wealth, worth around $70 trillion and currently held by about 60 to 70 million people. But the upcoming generation of investors, they're not going to invest in stocks and bonds in the way that they saw their parents and grandparents do. They're favoring alternative assets such as collectibles and cryptocurrencies. See, while some people are focused on short-term price moves, if you take a bird's eye view, we're on the brink of a great wealth transfer. Now, ignore it at your peril. You're either going to stick your head in the sand and ignore the outpouring of trillions of dollars from the stock market into these alternative assets, or you're going to take a preemptive position ahead of the trend alongside tomorrow's wealth builders. Stocks and bonds were a boomer favorite. So all told, the average boomer has about half his net worth locked away in these traditional asset classes. It's no wonder, as these two assets have been powering their growth for decades, right? 1985, effectively the midpoint of this generation, coincided with the start of one of the greatest stock market rallies in history. And since then, the S&P 500 has consistently returned an average, listen to this, 11% a year, and that's after reinvesting dividends. That's enough to turn around 1,000 into around 60,000. Bonds also performed well, delivering an average annual gain of around 7% over the same time period on the Bloomberg US Aggregate Bond Index. But things are changing, and that's because millennials, the biggest demographic group in America, don't have the same faith in these assets. Millennials were in their 20s during the 2008 financial crisis and the crash, and it raised real doubts in the security of traditional financial systems. They have just 23% of their net worth in stocks or bonds. Instead of entrusting their wealth to these vehicles like the generation before them, they're turning to alternative assets like collectibles and crypto. And the standard portfolio model focuses on stocks and bonds. So we need to think outside the Wall Street box and traditional financial systems. Now, there are three key characteristics that make these alternative assets ideal for outpacing inflation. First of all, they're real, right? The harder it is to print an asset, the more real an asset is. Secondly, rare. These are assets with low supply. And thirdly, enduringly desirable. In other words, they have a history of high demand from wealthy people. Let's look at crypto's flagship currency, Bitcoin, in line with these three characteristics, right? So first of all, we said real. Well, new Bitcoin can only be mined, and it's an expensive business that requires banks of high-powered computers consuming large amounts of power. Traditional central banks can't print more Bitcoin. Secondly, we said rare. Well, the supply of Bitcoin is capped at, you know how many million, right? 21 million coins. It's written in the program. And thirdly, enduringly desirable. And since it started, adoption has swelled from a few programmers to over 180 million people, including some corporations and Wall Street institutions. And in a tech-focused world, Bitcoin's ability to satisfy these essential criteria cements its position as the gold standard championed by younger generations. A quarter of the population under the age of 50 have invested in or used a cryptocurrency, while only about 7% of investors older than 50 have used one. See the trend? In a similar vein, millennials with the most disposable income are allocating about 15% of their portfolio to cryptos, whereas investment rates for boomers are just 2% of the average investor's net worth. See? So Wall Street is taking notice. The oldest bank in the US, Bank of New York Mellon, BNY Mellon, announced it was launching a new service to store clients' cryptos. BNY Mellon is also the world's largest custodial bank by assets, and its clients want institutional-grade solutions in the crypto space. For years, small offshore firms have made billions of dollars providing crypto trading and custody services to BNY Mellon clients, while the bank looked on, but they're ready for a piece of the pie. And they're not alone. Major Wall Street players, BlackRock, JP Morgan Chase, Goldman Sachs have all added crypto services over the past year. Crypto is seen as the asset of the future, and these institutions have remained at the forefront of their industry by consistently recognizing and positioning themselves for high growth opportunities. Trillions of dollars are about to be transferred from stocks and bonds to crypto, as millennials inherit generational wealth. That's why today's Bitcoin bear market is such a massive buying opportunity. Bitcoin has plunged 72% again from November 2021 highs, but we mustn't confuse short-term market weakness with what people might think is a long-term erosion of Bitcoin's value. Price does not equal value. Let me repeat that. Price does not equal value. Most investors can't wrap their heads around this concept, and so even though it is a normal temporary slump in price, not value, that will recover, and so these same investors are offloading their Bitcoin. Rather than grasping this as a temporary ailment that will repair itself, they're dumping their Bitcoin. I'm repeating myself now, but you should be seeing this market as a bargain buying opportunity. We are investors and or traders, and this is how we profit from volatility, right? We buy low. I'm not saying put everything in Bitcoin at one go. No. I think we'll see significant short-term volatility with prices possibly dropping further from here before climbing again. But with our CCA strategy, you can build a position now that you will be proud of in the future. Crypto cost average. Set aside a fixed amount of what you earn each month, 10%, 20%. When the price of Bitcoin falls, we buy more to lower our average price. I mean, now, from 68,000 to 20,000 now, right? Is it a good time to buy? I'm buying. But won't it go lower? Possibly, and then I'll buy some more. But if it doesn't go lower, then when are we going to buy? At 30,000? 40,000? 50,000? Or when it goes back up to 68,000? When are you going to buy? No, I'm buying my allocation now and pray it goes down even lower.